Good afternoon, everyone. Thank you for joining the webinar today, which is on cash flow statements and is part of our overall series that we're carrying out on Rethinking Social Housing webinars, the webinar series. Just in terms of today's speakers and intros, so in terms of myself, my name is Hamid Ghafoor. I'm a partner who sits in the north of England with BDO. I lead BDO's social housing team across the north, and in particular around social housing. I've been involved in the sector for around 25 years now, with a variety of different roles within the sector. Also presenting today is Andrew Holt. Andrew Holt's a senior manager in our TSG team with a specialism in social housing. So Andy, in terms of the seminar today, will give you a bit more practicalities around some of the issues around cash flow. And following up from that is Paddy Jenner, who's a senior manager in my not-for-profit team. And Paddy's going to talk about some other accounting reminders that you should be aware of for this year. So in terms of today, why are we here today? And I think that really, in terms of the agenda, and that's really what I'm going to talk about a little bit in terms of the agenda today, about what are the issues, higher level issues around cash flow statements and why we are presenting this seminar. Andy will talk in terms of back to basics, in terms of in terms of cash flow and the importance of cash flows, and then give some examples around that from a practical perspective. And then Paddy will talk through reminders from a wider perspective in terms of what we're that you should be aware of. That links into the accounting piece as well. So in terms of why we're here today, I think what we find in terms of cash flow statements is that cash flow statements in themselves are an incredibly important element of your financial statements. They are a primary statement. So in the same way, your income and expenditure accounts and your balance sheets are primary statements, cash flow statements have the same level of importance. However, when we come to audit and review cash flow statements, the sense that we obtain is really actually because of the way cash flow statements are prepared. They're often prepared near the end of the process. Often there's a sort of focus on balancing cash flow statements rather than understanding the classification around some of the balances around cash flow statements. They do lead to a number of errors, and certainly, and a lot of those errors are preventable because they're easy to spot from just a basic review. So really today, the objective of the session is about understanding the cash flow statement, understanding those basics, understanding why it's important, preventing those errors, which in themselves I think is quite straightforward to do. Following that back to basics approach in terms of your review and making sure you have that level of importance of the cash flow statement as you have on other primary statements. How to build that cash flow statement, which Andy will talk around in more detail in his bit, and then tackling any complexities. But really, the complexities in themselves and cash flow statements are not that complicated. But why is it important? So yes, there's a piece around the fact that it is a primary statement, and that means that in any regulatory review that we have as auditors, it's an area of focus for the regulator because it is a primary statement. And what we found and what they found in terms of their reviews is that it's an area where there are significant number of errors, and that's just not in social housing cash flow statements, but across the piece, across all sectors. And the regulator's been pretty firm on this, that both companies and auditors must improve in terms of the production of cash flow statements and the audit of cash flow statements. And clearly from our perspective as auditors, if our clients are producing those cash flow statements in the right way, then we will, from our perspective, it'll be much easier to audit those cash flow statements. And as I said, it's an area of focus for our regulator. But now to talk a little bit more around some of the practicalities around producing cash flow statements and the basics around that, I'll pass it across to Andy, please.
Thanks, Hamid. Smooth transfer of seats. So, following on from the regulatory findings piece that Hamid talked about, in terms of the types of findings that the regulator and BDO internal reviews are coming up with, the first thing worth mentioning is that many of the findings coming out of both reviews are consistent in terms of the types of issues being identified. So it's the same errors being made over and over again. The findings noted numerous instances of non-cash items being included in cash flow statements. So, for example, we've seen new finance leases being included in financing activities as a cash flow item. Finance leases are typically a non-cash flow item and wouldn't appear anywhere in your cash flow statement. Several cash flow misclassifications. So particularly in the case of entity-only cash flow statements where intercompany cash flows weren't correctly classified. So less of an issue, in social housing where entity-only cash flows aren't necessarily the norm, but it is an important consideration where you are presenting entity-only cash flow statements, making sure you pulled out any intercompany financing transactions or intercompany investing activities, for example, where you've got a DevCo. In social housing specifically, there are instances of property for sale cash flows being presented as investing activities. This is an operating activity deriving from your principal revenue producing activities. So that'd be a misclassification if it's shown as an investing activity. Other findings were include issues around cash flows being presented net when they should have been presented gross. So for example, where you've got a refinancing transaction involving separate repayment and drawdown of a loan. We've seen instances where that's presented as a single line item, net off, to not really show any cash flow when the reality is there's been two significant cash flows taking place. We'll touch on gross versus net presentation later on. Quite a few cases where deposits with a maturity of greater than 3 months or deposits with significant restrictions were being included in cash and cash equivalents, which is an appropriate classification. Issues around defined benefit pension cash flows, how they hit the cash flow statement, and that's one of the specific examples we'll touch on. Construction additions and capital grant cash flows, that's something we see quite a lot in social housing, getting those numbers wrong. We will again go through both of those examples later on in the session. But perhaps the most alarming thing for us as auditors is a lot of these issues relate to really basic errors and errors that, as Hamid touched on, could be identified from a simple desktop review by someone who doesn't even know what the business does. So a key takeaway from these findings is that the majority of the issues will link to the application of a few key fundamental principles. Hopefully this session will help with that. So why do these errors occur? And Hamid's already touched on this. This statement isn't given the sufficient importance it deserves. It's a primary statement, equally important to your income statement and balance sheet, and it should be treated as such. Time pressure. Again, Hamid touched on this. Cash flow statements are almost invariably the last thing that's produced in the financial statements, and they're reviewed really late in the process when there isn't much time to correct those errors and really analyse what those balances are. If you stand back from a cash flow statement, it isn't something that needs to be left to the last minute. Once you've prepared your supporting schedules for each of your financial statement areas, at that point, the cash flows aren't going to change. You can produce a first draft of your cash flow statement. The only things that are going to change from there are really the pots that the different categories sit in within your operating activities reconciliation. And provided you've got a good record of what adjustments have taken place from your first version to that version, that's a very simple job from a cash flow perspective. So the majority of the items in your cash flow statement won't change after the year-end date. We've noted a significant over-reliance on roll-forward and often complex spreadsheets. These often contain formula errors or hard-coded figures that no one really knows what they relate to anymore. Not enough information on those spreadsheets to explain to the reviewer or anyone following those in future years, how you've come up with particular figures. A really, really important one is attention isn't being given by senior staff in reviewing the cash flow statement and the financial statements generally. It's the senior staff who are involved in a lot of these transactions that really should be in the best position to know whether a transaction is being presented properly from a cash flow perspective. So if there's been major stock swap transactions, a transfer of engagement, they're going to involve significant non-cash items that need to be reflected or indeed not reflected in your cash flow statement. Certainly, we've noted a lack of understanding the mechanics of a cash flow statement, and the final item on there is complex transactions, and you see there's a question mark there. I'd sort of challenge whether in social housing we have that many complex transactions. Once you have an understanding of basic principles, a lot of it isn't too complicated. We're not in the corporate world where we might have foreign exchange, overseas subsidiaries to worry about, or complex acquisition and disposal transactions. So if we have those fundamental principles of an understanding of how the cash flow works, we should be in good shape to avoid the sort of errors that have been identified. So going back to basics, what does the cash flow statement tell us? Excuse me. So all organizations need cash to run their day-to-day operations, to invest in their assets, to pay their obligations, and in the corporate world, to provide a return to investors. So that's regardless of the line of business or geographic location. So the objective in this area of UK GAAP is to require entities to report historical changes in cash and cash equivalents by means of a statement of cash flows, classifying the period's cash flows by operating, investing, and financing activities. So as a result, this statement provides financial statement users with insight in how the entity generates and uses cash and cash equivalents. As we've highlighted there, the cash flow is a primary statement. It means it's got that equal importance to the balance sheet and income statement. Can't emphasize that enough. And as per the overused phrase, cash is king. It is true. In a world of accounting estimates and fair value adjustments, the cash flow statement provides, hopefully, unbiased and objective financial information to the users of the financial statements. So I touched on there the classifications that you'll see in the cash flow statement. So that is operating, investing, and financing activities. So I'll come back to operating activities shortly. Investing activity is activity that relates to the acquisition and disposal of long-term assets, so your housing properties, and other investments that aren't included in cash and cash equivalents. So that is payments to develop your housing properties, cash receipts from capital grants, and payments, cash payments as part of investments in joint ventures, for a few examples. Move on to the next slide. Financing activities are those activities that result in changes to the size and composition of the contributed equity and borrowings of the entity. We tend not to see many equity cash flows in social housing. So this area mainly consists of issuing, repaying, and servicing of your debt. We jump back, making it hard for the person driving the slides. Coming back to operating cash flows, these are those that result from the principal revenue producing activities of the organisation. So this would be cash receipts from the sale of goods and services. So in social housing world, that's rental income and outright property sales. Also payments to suppliers for goods and services relating to operating costs, payments to employees, and helpfully this is your kind of catch-all area as it consists of any activities that are not investing or financing activities. So they're the pots we need to work with. So who are the users of a cash flow statement? So whenever you review any financial statement, you should consider it from a business perspective. So financial documents are designed to provide insight into the financial health and status of an organization. So this slide summarises who the key external users cash flow statement are and what they're looking for in terms of the business story they're looking to understand. So firstly, we have creditors. So this is working capital creditors. These creditors will be concerned with liquidity of an entity and its ability to pay month-to-month bills, electricity, staffing costs, goods and services purchased on credit. Creditors are also interested in operational cash flows. So this will tell a creditor whether an entity is able to generate enough cash from core activities to meet obligations, as opposed to relying on debt to make those payments. In terms of banks and lenders, banks will want to know in very simple terms, can an entity service and pay back a loan? They will look at a cash flow statement because it helps them to understand whether the information they're being told by management of the business is consistent with the underlying position. This cash flow statement, as I said, it doesn't have the fair value adjustments or accounting estimates in it. It's a really powerful tool to understand whether the business story is consistent with what they're being told. Finally, in terms of investors and board members, RPs tend not to have investors in a traditional sense. There's no shareholders as such. However, you could equally substitute in here non-executive board members who'd be interested in a number of the same areas of the cash flow statement. So board members will want to know what the outlook and direction of the business is, i.e. where are we as a business, how much has been invested in growth. So this will impact. The cash flow statement is a very powerful tool in understanding the going concern assessment that the board members are required to sign off on. It's also really important in making decisions around development strategy and risk appetite, which is vital to an RP's future direction. If you don't do already, or if you are a board member, I'd be insisting on cash flow statements being part of that management accounts pack that you're receiving on a monthly or quarterly basis. A really powerful tool if you know how to use it. So how do we approach preparation of a cash flow statement? I'm sure many of you have seen and used cash flow Excel workbook templates for preparing a cash flow statement. So these schedules are all slightly different, and some are better than others, but what they all have in common is they show the opening and closing balance sheet items side by side and the difference that then needs to be allocated into the different areas of the cash flow statement. Might seem a very obvious statement that the sum of all the movements of your individual statement of financial position items will be equal to the movement in cash and cash equivalents. So that's something to bear in mind in what you're trying to achieve when you're preparing a cash flow statement. In step 2, we analyse out the movements that we've identified in step 1 into cash flows versus non-cash flow items. So obvious example of a non-cash item would be the movement in your housing properties balance that's due to depreciation. Depreciation is a non-cash item that you need to analyse out separately and add back effectively to get back to your cash position. You then further analyse cash flow items to determine whether it should be presented as operating, investing or financing. You might have items that sit in various pots. So as an example of that, you might have an overall accruals balance that includes loan interest liabilities, construction accruals, or general accruals. So each of those sit in a different pot. So your loan interest movement is part of your financing cash flows. Construction accrual movement is part of your investing activities movement, and general accruals will probably most likely sit in operating activities. Step 3 is where judgment needs to be applied. So you might, for example, have a short-term investment. That short-term investment will only meet the definition of cash and cash equivalent when it meets the criteria, which I'll cover slightly later on a separate slide. You need to be really clear on your classifications and your judgments that you're making. Where you are making judgments or accounting policy decisions in relation to your cash flow statement, it's really important that they're included in the notes of the financial statements. So we very rarely see accounting policies on cash flow statements, but it is really good practice to have accounting policies in that area. For example, why you classify certain balances as investing as opposed to operating, those sorts of things need to be noted in the accounts. In step 4, we get to the point where we are balancing our cash flow workings. Obviously, if they don't balance, you post the difference to the creditors movement. That was a joke. You absolutely do not post the difference to the creditor movement. You don't post it to anywhere until you fully understand why the cash flow doesn't balance. It might indicate an error has been made elsewhere, or that there's an error generally in the financial statements that needs to be analysed. But you would be surprised how often we do see differences in creditors, and it usually stands out like a sore thumb as a huge creditor movement in operating activities when you just wouldn't expect that in most instances. As Hamid's already said, balancing your cash flow statement is just one of many steps that you need to perform, and it's not the most important one. The most important thing is to appropriately classify and present items in the statement of cash flows, as well as disaggregate and analyze the movements correctly. So here we've got an example cash flow statement workings spreadsheet. So this is heavily abridged, so most of the columns and rows aren't included, but it's just to give you a kind of a flavor of what this workbook would look like. As I said, these templates come in many shapes and sizes, but they're all got common features. So this one, for example, has got each financial statement area across the top. So your housing properties, investment properties, other fixed assets, that will continue into each separate line of your debtors and creditors, so trade creditors, accruals, etc. The more detail you break those out into, the easier it is to do the cash flow statement. So I've touched on accruals already. If you split accruals out into capital accruals, interest accruals, general accruals, you might also want to think about construction liabilities that you know about within trade creditor balances. So you have all those items and your reserve categories across the top. You have the opening balance per the balance sheet and the closing balance per the balance sheet, which gives you a difference. That's the difference you need to allocate out between non-cash flow movements and operating cash flow movements, investing cash flow movements, and financing cash flow movements. Then once you add across each of those rows, it gives you the cash flow on the right-hand side if you've done it correctly. That will then feed into your cash flow statement. I'll touch very briefly on this slide because it isn't something I see an awful lot in practice in the social housing world. So you are permitted to use either the direct or indirect method in presenting operating cash flows only. So it doesn't impact on investing or financing cash flows and how you present those. The direct method reports the major classes of gross operating cash receipts, for example. So for example, cash collected from customers, you'd include as a single line item in your operating cash flows, or gross operating cash payments. So for example, amounts paid to suppliers, cash paid to employees, for example. These gross operating cash flows are aggregated to produce the entity's net operating cash flow. The vast majority of organizations use the indirect method. That involves starting from a surplus or deficit measure and then adjusting for non-cash items and items that sit separately within investing or financing cash flows. There's an example there that you may want to consider in your own time once we circulate the slide pack. But as I said, as we move on to the next slide, the indirect method is what we tend to see in practice. So this slide shows you an example cash flow statement. Apologies, it's a real test for the eyesight. Hopefully you can just about make out the numbers and the line items. On the left-hand side, you can see an example of the indirect method of presenting operating activities. You can see it starts from surplus for the year, then adjusts for the non-cash items such as depreciation, grant amortization, and it adds back items where the cash flow sits in either investing or financing activities. A few quick points to make whilst you can see a full cash flow statement on screen. So this example starts from surplus for the year. It wouldn't necessarily be wrong to start from operating surplus, as a number of RPs like to do. The requirement under UK GAAP is to start from a profit measure that is identifiable in your income statement. So that is something you can think about. Secondly, whilst we can see all the numbers, just want to stress the importance of a year-on-year comparison. So the preparer and reviewer should be looking at each individual line item and understanding the movement. This analytical review often leads to identification of errors and omissions, not just in your cash flow statement, but errors in your financial statement preparation. So it's a really important thing to do. So in this one, for example, you can see there's a significant gain on acquisition of a separate housing organisation. So that would be a one-off item, so very easy to explain. You might look at another item where you've got a fairly chunky decrease in creditors of 9 this time. Does that make sense in operating cash flow terms? Do you understand why that's happened? Should there be a cash flow there that is actually related to investing activities? Those are the sort of considerations you would have. Finally, really important that you get the row descriptions right. So almost every cash flow statement I'll look at, there's at least one row description that's incorrect. If you're following the usual approach of using brackets for cash outflows, so as an example, decrease / brackets increase in trade and other debtors, make sure you have the words in the right order. So either decrease or increase, is it current year or prior year? And making sure you get the brackets around the right words in that sentence to reflect it's either an inflow or an outflow, or an increase or a decrease in cash. However many times I've done it, I always have to take a step back and think, if I've got an increase in stock or an increase in debtors, that means I have less cash because I've got an asset. Reverse is true for creditors. If your creditors increase, you have more cash. So I'll just cover off a few practicalities before we get into the examples. So in terms of group considerations, really important that you're only reflecting cash flows that are external from the group. Where you've got any entities joining the group or leading the group during the year, important that the cash flows only reflect the portion of the year that the parent controlled the subsidiary. In terms of approach, almost always you would see the consolidated accounts as the starting points after you've eliminated any intergroup transactions. It's equally valid, but much more difficult to produce individual entity cash flow statements and then include the relevant proportion of those cash flows in your group cash flows. In terms of common errors that we see on group cash flows and on consolidation generally is double counting of costs and property sale income where a devco is involved, and failing to eliminate the related intergroup profit. Similarly, with devcos, failing to get the correct classification. So you might have an item that's stock in current assets in devco, but housing property in group. That can have implications not only for the accounts, but for the cash flow statement as well. And failing to eliminate intergroup finance costs and income and the related margin. So for example, where you've got a finance vehicle for bond listings, etc. Another aspect which seems straightforward but seems to be an area of confusion in practice is knowing what's included as part of cash and cash equivalents for the purposes of the statement of cash flows, more specifically when it comes to determining what is considered to be a cash equivalent. So cash equivalents are defined in FRS 102 as short-term, highly liquid investments that are readily convertible into known amounts of cash and which are subject to insignificant risk of changes in value. This definition might result in a different number presented in your balance sheet under cash, as opposed to the number used in your cash flow statements, cash and cash equivalents. So if this is the case, it's really important that a reconciliation is disclosed in your accounts. Some of the nuances to look out for. The first requirement is for the investment to be held for a short term, if it's to be a cash equivalent. To qualify as such, the investment will normally have a maturity of 3 months or less from the date of acquisition. It's really important to emphasize that. It's the date of acquisition that drives whether it can be included as a cash equivalent, not the period to maturity from your balance sheet date. So date of acquisition is key there. It's important to note that even if an investment meets the definition, but is not held for the purposes of meeting short-term cash commitments, it can't be part of your cash equivalent. So if you've got a £10 million deposit investment, even if it's only 90 days or 60 days, if it's always there, £10 million, it isn't used as part of your cash management, it isn't going to be a cash equivalent, it's going to be a current asset investment. Also need to think about any restrictions that exist over items that appear to meet the definition of cash and cash equivalents. These restrictions could result in an item in the definition not being met. Additionally, restrictions over the use and access to cash can result in certain deposits being excluded from cash and cash equivalents in the cash flow statement. A further point worth mentioning is the fact that the definition of cash and cash equivalents makes no reference to the inclusion of bank borrowings. Bank borrowings are usually considered to be financing cash flows. However, UK GAAP does acknowledge that bank overdrafts, repayable on demand, might form an integral part of an entity's cash management, in which case they can be included in your cash and cash equivalents. So for it to be included as such, a characteristic of such an overdraft would be that the bank balance regularly fluctuates between credit and debit. So it goes from being overdrawn to being in credit again. So that's something to look out for. Just before I go into the examples, a really important caveat to make is that the following slides are only examples. There will almost certainly be other items that you need to adjust for in arriving at your entity's cash flow, so don't take this as gospel. Please take that into account as I'm running through these examples. The other point to note as we're going through these examples is it's really important not just to calculate your cash flow balances, but also retain the calculations and the related supporting schedules. These will be needed by your colleagues and auditors to review the cash flow statement. You should also make notes on how the cash flow has been prepared, either on the schedule or separately on a workings tab, to allow others to understand your work. And finally, remember that this year's cash flow workings is the starting point for next year's cash flow workings. So the clearer and more detailed analysis you produce as part of your cash flow statement preparation, the easier the job will be next time around. So the first example we've got here is the cash flow related to the defined benefit pension scheme. So this is an item that is often wrong. I'm not sure whether it's a lack of understanding of the mechanics of how the cash flow statement is produced, or a lack of understanding of how a defined benefit pension scheme movement works. But the balance that I most often see wrong is the difference between the defined benefit pension expense and the cash contributions actually made. So if we break this into two parts, we can usually pull these figures directly from the pension note. So here, hopefully your eyesight again is good enough to see the items that are highlighted. Sorry, just making my screen a bit bigger. As I said, you can pick these items up from the pension notes. On the right-hand side is a pension extract from that pension note. At the top, you've got your movement in the defined benefit obligation, and below the movement in the assets of the scheme. So the items that hit operating cost in defined benefit pension schemes are typically current and past service costs. You can see here we picked up a figure of 2 from the note. That's an add back because we've expensed that, but it's actually a non-cash item. It's a notional expense. We'd also pick up any expenses. So here we've got 1 that we've added back, and also here would be any settlement costs if there've been any significant changes in the scheme during the year. Again, all of those non-cash items from the companies for the organisation's perspective. All those are add backs. We then pick up the employer contribution down in the asset section, and that's 6. So we've got a cash outflow of 6, and we've added back the 3 to give us a net cash outflow of 3, which in our case is our cash flow. Couple of reminders: pension finance costs are usually dealt with separately in the operating section of the cash flow statement. We'll touch on that when we look at interest payable. And employee contributions are not included in this analysis. It's the member contributions, so the employer contributions. Sorry, it's the employer contributions that we're dealing with, not employee. In terms of capital expenditure on fixed asset housing properties, again, this should be a relatively straightforward one, but it's very surprising how often we see it isn't necessarily correct. So again, you can pick up, you usually get very close to the figure by looking at certain notes to the financial statements. So you see our starting point is the housing properties note. You can see in the cost section of note 13 there, we're picking up the additions figure and the components capitalized figure. Sometimes they're split out on separate lines. Often, as in this case, they're included as a single capital expenditure on housing properties. So we're bringing in an outflow from those two figures of 71 and 15. Amazing how often we'll see this figure in the financial statements cash flow will be exactly the same as the additions figure in the housing properties note. That almost every time tells me that something has gone wrong, because you wouldn't expect it to be exactly the same. There's usually some add backs and deductions. The main one you need to think about is taking into account any creditor movements. So you can see our note 21 creditors on the right hand side. We've got a separate line item here. Again, the more granular you are in your notes, the easier it is to do the cash flow statement. So we've got a movement in construction liabilities. So we had an opening construction liability of 5. So we'll have paid that during the year. So that's an outflow of 5 that you can see on the left hand side. We've got a closing construction liability of 24. We haven't paid that yet, so that's an add back. We haven't yet suffered that cash cost. So taking all those into account, we have an overall cash outflow of 77. You can see that's quite a bit lower than if we did just pick the figure up from note 13, the housing properties note. Again, a reminder, you might need to analyse out opening and closing trade creditors if you've got any capital liabilities in there. Also think about capital retention liabilities. The movement on those will impact on your cash flows. And you really need to think about any non-cash additions that you're aware of. Again, that's the importance of senior people being involved in preparation of the cash flow. So they could be stock swaps, no cash changing hands, or business combinations. You can see in this example, we've got transfer of engagement, which is a major addition to housing properties. Helpfully, it's set out on a separate note here, so we've not got confused and included it as a potential cash flow there. But any non-cash items need to be separately analysed. Capital grant additions, again, a big cash flow in the year, and it's really easy to get wrong. But again, most of the figures come from notes to the accounts. So our starting point here is the deferred capital grant note. So you can see that on the right hand side, we've got a grant received in the year figure of 20. So we're starting with that as a cash inflow. We again need to take into account debtor and creditor movements. So from our debtors note, we've picked up there's a significant increase in grant receivable. So quite often at the end of the year, there's a lot of grant claims submitted. So you've reached the point where you are able to recognise the grant that you haven't yet received payment from the grant body, usually Homes England. So in this instance, we've got a significant increase in debtors. So it's gone from 3 in the prior year to 17 this year. Our debtors have increased. That means our cash hasn't increased. That's a cash outflow in this calculation. So we've got -14, as you can see on the left-hand side. Creditor movement, again, we need to take that into account. SHG received in advance, that's increased from a liability of 1 to a liability of 4. If our creditors have gone up, our cash has increased. So that's a cash inflow of 3, being the difference there, giving us a net cash flow of 9. An important reminder is to deduct any grant from the Recycled Capital Grant Fund. That's a non-cash item. You can see helpfully our note 24 includes Recycled Capital Grant Fund as a separate line item, so we don't incorrectly include it as a cash flow item. Again, you need to consider any other non-cash movements. So a business combination, for example, where you can see here we've got 44 coming in from a transfer of engagements. That's a non-cash item that we need to exclude from the cash flows. In terms of proceeds on sale of housing properties, this is one that again is quite often not correctly analysed in the cash flow statement. You should be able to get pretty close to this from the notes if the notes are in sufficient detail. So I would expect the cash flow from proceeds on sale of housing properties to be very close to the figure that's disclosed in the surplus on sale of fixed assets note. So you can see in this instance, we've got a net cash flow of 18, and in note 5, you can see that we have the top 2 rows of housing property transactions, 7 and 11. So that tells me that that figure's probably there or thereabouts. But if you go through the mechanics of how this would work, if you're analysing out the separate items within your cash flow workbook, so the starting point would be your housing properties note. So here, note 13, what's the net book value of your properties disposed of? So here we've got cost of 18 disposed of and depreciation of 3, giving us a net book value of 15. You then, as we jump onto the following slide, pull out your grant disposed on any property transactions. So you can see in note 24, our deferred capital grant fund, we've disposed of £5 million worth of grant, less £1 million worth of amortization, so a net 4 million cash outflow. We then add back any grant recycled into the Recycled Capital Grant Fund. So we can see in note 25, we've got 5, a 4 and a 1 picked up there. So that is excluded from the cash flow. And then we deduct the surplus on disposals as we jump back to note 5 on the previous slide. And then that gives us the figure of 18. As I said, that was my expectation at the start, but that's the mechanics of how we actually get to that transaction. So this mechanical transaction here, that is purely a sense check. What I'd expect in the real world, in your accounting records, is you'd have a separate supporting schedule of all your fixed asset housing property disposals in the year, which would detail how much you sold each for, and that would give you a total that you would need to reconcile to if you're coming up with a different figure here in terms of the cash flow. Just to think about whether this is an operating or investing cash flow, you might have noticed on the example earlier in the document, you can go back to that if you want, once you have hold of the slide pack. This is treated as an operating activity in this example. We've done that because surplus on disposal of fixed asset housing properties is treated as usually as an operating item. It's above operating surplus in the statement of comprehensive income. Some some registered providers do include it as an investing activity. They don't consider it to be part of their revenue generating activities. That's not necessarily wrong, but we would expect you to include an accounting policy or a judgment as to why you decided that it needs to be an investing activity as opposed to its income statement presentation as operating. You might or might not need to think about property sale debtor balances. They tend not to occur where you have individual property sales, but they might occur where you've got a whole raft of stock that you're selling to another RP or to another third party. The other thing to think about is often your disposals in the housing properties note might need further analysis with supporting schedules to get to the figures you're looking for. So in this example, note 13's got separately component disposals and actual disposals of property. Often they're grouped into a single line item, so you need further analysis to get to the cash flows relating to actual property disposals as opposed to just replacing a kitchen or a bathroom. So the fifth example is interest paid expense. So again, I've got here in this example, and I would encourage all of you to do this, there's lots of analysis in the notes to help you to get to the right cash flow items. If you don't produce these items in the note, it will require further separate analysis via spreadsheets, and spreadsheets are notorious for going wrong. So how do we get to our interest paid cash flow? So we start from the interest paid expense. So we pick up the 27 there. So we pick that up from either the statement of comprehensive income or from note 8, you can see here. So that's a cash outflow of 27. We then need to factor in any capitalized interest. So this doesn't hit your income statement, but is a financing cash flow. So any interest that we capitalized, we need to add that back here. So you can see here we've got an extra 5 cash outflow there for any capitalized interest. We picked that up from note 8, but we could have equally picked that up from the housing properties note. Do remember to check any capitalized interest in relation to your stock balances, so properties for resale. That movement won't be part of your stock movement working capital balance. It'll be a financing cash flow, and you need to analyze it separately. You can then see we're adding back some non-cash finance costs. So we've got 2 there, and we've arrived at that, if you look at note 8, from some arrangement fees that have been amortized or written off, less loan premium that's been credited to the income statement. So that 3 less 1 is an add back of 2. We exclude any pension finance costs of 2. The 2 is the pension and finance lease interest. Both of those don't relate to bank interest, so we've added those back. Again, we need to think about our opening and closing creditor balances. Again, note 21 has helpfully split out interest payable accruals onto a separate line item. So we've got opening liability of 6, closing liability of 7. Creditors have increased, so I've got more cash, and I've got a 1 positive in the on the left-hand side in the calculation. And finally, there's a transaction through an analysis to take out the cash flow relating to the payment of any interest rate swaps. So this is a good practice item to make sure that you providing as much detail as possible to the users of the accounts, and you should be splitting out the cash flows that relate to swaps as opposed to actual bank interest. Both sit in the financing section. If you jump back to the example, you'll see it's just a separate line item there. Again, as I've been saying, this is the mechanics of the transaction, but you'll almost certainly have a separate workbook showing all the interest payments that you've made during the year, and that's something that you'd reconcile to if there's any differences. So example 6 is on loan movements. Hopefully you can just about read the very small print, colourful monstrosity on the right hand side. The key point to make here is you can't usually derive cash flows directly relating to your loan movements directly from the notes to the accounts, because there isn't usually enough information to be able to do that. So what this spreadsheet extract that you can see on the right hand side is doing is taking each of your loans, it's taking any amortized cost adjustments to your loans separately, any discounts or premiums that you have attached to your loans. Each of those are listed on the left hand side, and you've then analysed out each of your cash flow movements and any non-cash flow movements. So cash flow movements, as you'd expect, would be new debt drawdowns, loan repayments, debt issue costs incurred. Non-cash movements might be the amortization of debt to the income statement. As you know, you account for your debt on an amortized cost basis. So there's an initial kind of fair value adjustment in relation to your debt, and the release of that is a non-cash item. And also you can see the final, hopefully you can see the second from the right column is cash assumed on a business combination. Again, that would be a non-cash item that you need to not reflect in your cash flow statement. We will touch shortly on how that ends up being presented in the accounts. I will come back to debt issue costs and gross versus net, as I promised earlier. Just whilst we're in the area of loan movements, it's worth touching on the net debt reconciliation. This is a requirement under UK GAAP. So it's a note to the accounts that shows how your net debt has moved. So your net debt comprising cash and cash equivalents, finance leases, bank loans, bond liabilities, and any derivatives. You're required to show how they've moved from the start of the year to the end of the year. You're required to separately show how they've moved from cash flows, how they've moved from acquisitions and disposals, any new finance leases, and any other non-cash movements. Just some points to make quickly on this, and common errors I find when I'm looking at these is each of these opening and closing balances should tie into another area of the financial statements. So either the statement of financial position or the notes to the accounts. If they don't tie in directly, I'd expect additional analysis to show how they tie in. A really important point on the right hand side, you can see an extract of the bottom part of the cash flow statement example. And something that's missed in practice is the cash flow movements in your net debt reconciliation should reconcile to the cash flow movements in your cash flow statements. So just to illustrate here, you can hopefully just about see in the net debt rec on the cash line, we have cash flows of 79 and 20. So that's 99 in total. If you look to the bottom on the right hand side, that's equal to the increase in cash of 99. Similarly, the cash flows in relation to finance leases of 2, that is equal to the financing section of the cash flow statement on the right hand side where we've got -2. And the 105 on bank loans, you can see that cash flow reconciles to the bottom 3 lines of the financing activities. So the 133 bank loans drawn, the loan issue costs of 2, and the bank loans repaid of 26. Finally, it's really important that the non-cash items you analyse out correctly. The final point in terms of loans, just some further considerations in this area. In terms of gross versus net reporting, this is often something you have to think about when you're looking at your debt. So gross reporting generally provides more relevant information to the users of the accounts. However, netting off is permitted for certain items that have a quick turnaround. So if you have, for example, a revolving credit facility that's constantly being drawn down and then repaid throughout the year, it might be more appropriate to show a net either cash inflow from loan drawdown or a net cash loan repayment on your revolving credit facility, as opposed to showing hundreds of millions of pounds worth of loan drawdowns and hundreds of millions of pounds worth of repayment. Clearly a net figure is more relevant where you've got this type of short-term facility. In terms of on the right-hand side, constructive receipts and disbursements, this is where you present cash flows in your cash flow statement, even though they didn't pass through the entity's cash account. This might happen where, for example, you've got debt issue costs being deducted from loan proceeds, or on a refinancing transaction where there's a net off of loan balances and no actual cash flows have taken place. If the entity's non-involvement in a cash flow is for convenience, constructive receipt and disbursement might be appropriate. But if the non-involvement was by design, it wouldn't be appropriate to show separate cash flow items. Also think about disclosure there. So if you have got a refinancing transaction where you haven't actually paid any cash and it's just gone from one loan facility to another and you haven't had any involvement, I'd expect the non-cash flow there to be explained either in the debt note or as a footnote to the cash flow statement. Finally, the example I'm going to go through is of a business combination. So the most common business combination we see in social housing is a transfer of engagement. Thankfully, this is a relatively straightforward item, and we don't tend to have the complex acquisitions and disposals that you sometimes see in the corporate world. As a reminder, the required disclosure where you've got business combinations is in investing activities to show the net cash flows arising from gaining or losing control of that business. And the gross cash flow is then shown separately in the notes. So as you can see on the right hand side, this is an example of a business combination note where we've got a transfer of engagement. You can see all separately all the assets and liabilities that have come into the business, but the only one that hits the cash flow statement is the cash equivalents balance of 20, which is a cash inflow from a transfer of engagement. As I said, there's no consideration here, so there's no need for any netting off. Where you do have a consideration paid for any businesses that are joining, any acquisitions, if it's any deferred consideration involved, normally that would still be an investing activity, but it could potentially be financing or partially financing if the deferral period is sufficiently long. And where you've got contingent consideration and subsequent movements in the fair value of that contingent consideration, that needs to be treated as an operating activity. That isn't part of your investing activities. You just make your initial assessment of what the contingent consideration would be. Okay, so what could go wrong? These are, as mentioned previously, really. So it's movements not being appropriately analysed. Really think about, is it operating, is it financing, is it investing activity, making sure it gets in the right pot. Inconsistent application of accounting policy. So that's something I spoke about earlier as an example. Treating an item as an operating cash flow from a statement of comprehensive income perspective, but then treating it as either financing or investing for cash flow purposes. That's something that you should make sure you try to avoid. And the main one is probably failing to reflect non-cash items, or not reflecting known non-cash items, making sure that any additions to your housing properties that arise from, for example, stock swaps, are excluded from the cash outflow there. Next to the warning sign, you can see I've written the person preparing each section should be considering the cash flow impact as well. So if you're preparing the housing properties section, flag up any of those non-cash flows to your colleague who's preparing the cash flow section. If you're producing the accruals analysis, really helpful to the person doing the cash flow if you separately analyse any accruals that relate to construction, any that relate to financing transactions, really work as a team in that area. In terms of reminders and key takeaways, really, really important to treat the cash flow statement as a key area. It's really important that these are right. They're high on the regulators' focus, and we need to get them right collectively as RPs and as auditors. Second really important point, and again, I can't stress this enough, key staff who have that understanding of business activities in the year must be involved in preparing and or reviewing the cash flow statement. As per the example I gave earlier, you can start your cash flow statement earlier. There's no reason it needs to be the last thing that you do. The cash flows won't actually change. As I said, it's only the pots that some of the reclasses sit in operating cash flows that will change. Flag cash flow implications as you're going through each financial statement area. That's the point I've just made. It's really important to work as a team in making sure you get the cash flow statement right. Real focus on the location of key material items in the cash flow statement. So is it operating, is it financing, is it investing, or is it a non-cash item that shouldn't even be in your cash flow statement? Ensure figures that should tie into each other in the other areas of the financial statements are consistent. So as you can see, hopefully from those examples, the vast majorities of cash flow items you should be able to get close to just by a simple desktop review, and that should be something that someone is doing as part of the exercise before it goes to your auditors for auditing. Really important that accounting policies and judgments are updated in relation to your cash flow statement. Where you are making any unusual categorizations that you think might need further explanation, they're included. And as I said earlier, where it's important that cash flows, whether, say, for example, the front end of your financial statements are talking about a refinancing, and then there's no refinancing cash flows in your cash flow statement, that's the sort of thing that we'd expect disclosure of to explain why there's no cash flow. And finally, the importance of analytical review. Really important, that line by line analysis, understanding the cash flow movements year on year. It's surprising how often you can identify just by looking at a movement year on year that looks unusual, that there's an error somewhere else in the financial statements or an error in the cash flow workings. Okay, that's all from me. I will hand over to Paddy, who will quickly go through some accounting and audit reminders.
Hello, everyone, and thanks for your time. I thought that was brilliant from Andy, so really useful. We just wanted to quickly cover a couple of accounting reminders. I won't keep you long. I recognise what time it is. So you can see on the screen FRED 82, the FRC's most recent triennial review of FRS 102, published in December 2022, and they're expecting responses by the end of April 2023. Obviously, as one of the major firms, we will be responding to this, and if there are any issues or concerns that you have and you want to feed into that, by all means get in touch with us. The key areas here, as you can see, leases and revenue, and this is very much as expected as the FRC begins to continue moving towards alignment with IFRS. So leases closer to the approach that's taken by IFRS 16, i.e. that leases come on balance sheet, and revenue looking at the IFRS 15 5-stage process of contract revenue in particular. Both of those processes slightly simplified from the approach that is taken under the IFRSs, but the general movement of travel there is towards that IFRS style of accounting. Just to flag, effective dates periods 1 January 25 onwards. So for this sector, we're talking about March 26 year ends for those retrospective applications. But it's something that should be in your mind now as you think about the next round of refinancing, etc., or the next contract that you're bringing up and the impact that it could potentially have of some of these potential changes. So yeah, that's your accounting reminders. Then just moving on slide-wise. Thanks for that. So in terms of sector and so I think we've actually gone back slide-wise. Thank you. So yeah, just talking about sector accounting updates very briefly, and the positive point here really is there's very little change year on year that we need to be mindful of here. No changes in terms of the housing sort. The accounting direction for 2022 was adopted by the majority of our audited entities in FY22. Clearly, the main change there was the removal of disposal proceeds funds. So where that's already been adopted, we wouldn't expect to have seen those in the prior year. And ultimately, off the back of that, our focus here will be that we won't roll forward a new version of the FY23 financial statement model accounts, because the FY22 ones will be up to date, so they can be used now. And so no reason not to start building your financial statements now, so we can get early reviews in the diaries and really get that process moving nice and quickly. And then just finally, in terms of as we come into the period where we're auditing, what are we as the auditors thinking about? What are we hoping you're going to see within your your strategic front ends? There's quite a lot of information here, I guess, on the slide, but just picking out some key areas. In terms of the economy, rent arrears, clearly with the cost of living crisis and the impact of that and how that is impacting on your tenant population is going to be key, and how you're dealing with that. Aligned with that, a lot of organisations conduct a lot of development, and the impact of your development programme, potentially from increases in the cost of materials, but also from potential impacts to third-party contractors who you're working with. Then think about interest rate increases. There's a greater exposure here potentially where interest rates are increasing, and the impact that that might have on covenants, for example. Funding more widely, given where we are from an economic position, the availability of funding may well change, and that can have an impact in terms of loan covenants and proposed future financing expectations. In terms of tenant safety, I think the key thing here is really that real focus on the mould and damp and potential risk there, and how that's become a real focus, especially from the government in terms of their oversight of development versus remediation of current stock, and ensuring that that is done in a very balanced way. And then finally, in terms of climate change, it's very much like the position with Fred 82, something that's coming down the line. There's very much a direction of travel here, and organisations within this sector where you're doing significant amounts of development need to be aware of the impact that that's going to be having on the environment going forward, and being very clear within those front-end disclosures about where you're going more generally. So at that point, just in the interest of time, I'm just going to hand back to Andy very quickly to pick up any questions that have been received during the seminar.
Thanks, Paddy. Okay. In terms of questions, we've got a couple through that are cash flow related and a couple of logistical ones. I'll go through these as quickly as possible. So one question is, can you add extra lines to a cash flow statement to provide additional detail? Yes, you absolutely can. The idea is your financial statements are as useful as possible to users. So I had, when I was in the audit world, an organisation that wanted to disclose separately expenditure on developing current asset property for sale. So they added back the surplus on that transaction within operating activities and showed separately the expenditure. So yeah, absolutely you can. And secondly, how do I deal with tax in the cash flow statement? So I guess similar to interest payable, the key thing that you try and do there is to get to the cash flow. So again, you would start from the expense for the year being an outflow. You'd look at your movement in creditors, and you'd look at your movement in deferred tax, either debtors or liabilities, and that would get you back to the cash flow. A couple of logistical points. Yes, we are sharing the recording. That'll be circulated along with the slides today or tomorrow. And would you have a sample of the financial statements you would be able to share, please? Absolutely. If you contact your audit manager or anyone on the slides that you get sent through, they'll be able to share the example accounts. I think that is the end of today's session. So apologies for running over slightly, and thank you for joining us today.